Hi everybody, thank you so much for joining me here on another video. Today we're going to be talking about implied volatility, and as an options trader, it's something that you absolutely have to know, otherwise you're going to get crushed in the market. Welcome back to all of our subscribers, and a warm welcome if this is your first time here. My name is Kirk with Tactical Options Trading, and we make videos just like this on a consistent basis where we talk about the stock market and options trading. If you'd like to learn more, we have a lot of videos here on our YouTube channel. I hope you'll consider subscribing and clicking that bell while you're at it so you don't miss out on any future content. All right, guys, let's get into it. We're talking about implied volatility. One of my favorite subjects when we're talking about trading and options trading. Now, if you were to mention implied volatility to any other person outside of the option trading world or the trading world in general, they would probably be going like, implied volatility, who needs to know about that? But as an options trader, it is something that it gives us our edge, and I'm going to talk about that here in the video, because when we're talking about implied volatility, if you're on the wrong side of implied volatility as an options trader, you will absolutely get killed. You'll get crushed in this market. So let's talk about it. Let's talk about why it's so important. So let's talk about volatility in general. So when we're talking about volatility is the amount the market fluctuates over a certain period of time, and it has nothing to do with direction. So let's take a look at a couple of stocks here just to kind of illustrate this point. So we're talking about stock A here. Stock A is a low volatility stock. You can see it trades in a very narrow range, let's say from about $30 to $32. You can see this blue line here. It doesn't really, it's not moving very much. It's just kind of real, docile, not a lot of movement in the stock, not a lot of fluctuation. Now let's take a look at stock B. We got high volatility, $20 to $65 swings. So we're looking at a lot of volatility here in stock B, and that would be considered a high volatility stock. But the ironic thing is that most traders don't look at volatility. Most traders are just trying to get the direction of the stock right, and they're mostly just looking at direction. They're really not looking at volatility. But as options traders, as I mentioned, understanding volatility is absolutely essential. So in general, there's really two kinds of volatility. There's historical volatility and there's implied volatility. So let's take a look at what those two are. Let's kind of define what those terms are. So historical volatility is a statistical measure of the dispersion of returns for a given stock security over a given period of time. So with historical volatility, basically we can look back over a certain period of time and say, yeah, that stock was volatile. We can see that stock was volatile. Statistically, we can see that it was volatile because it's actually happened. It's already happened, and we can see what the historical volatility of a stock has been. But however cool looking back in time is and seeing what that historical volatility is, we as options traders are interested more in what the volatility is now and what it will be out into the future. But looking forward, it's virtually impossible to know what the volatility will be in the future, but there are some measures that can help us get an idea of the expected move or the expected volatility into the future. And this is where implied volatility comes into play. So implied volatility, or future volatility as I like to call it, is a result of option buying. So let's think about this for a minute. So you see over months and weeks and days, options traders will start to form their opinions of where they think the stock will go based on earnings, news event that's going to be coming out, technical analysis, etc. You name it. Somebody's got a hot stock tip. Somebody's saying that this stock's coming out on the market, get in early. Whatever that is, traders come up with these assumptions of where they think that stock's going to go. And traders will start to buy options based on these assumptions. They'll start to speculate. So this buying will change the option pricing based on demand, but the stock price itself may or may not even be affected. So let's say, for example, you're an options trader, or maybe even just a stock trader, and you have 100 shares of stock that you want to kind of buy some insurance for. So you have 100 shares of long stock. You want that stock to go up, but you want to protect yourself to the downside. You heard some news is coming out. So you're going to be looking at interested in buying some puts. So you're going to go out and buy some puts. Now somebody else might be looking at maybe just speculating on this stock, maybe making a big move upward, and they're going to go out and buy calls. So this option buying starts to create a lot of speculation in the market and creates this this implied volatility of where the stock might go. So this implication, or looking at these options, series of options, you can get an idea of the feel of where people feel, or where this volatility is implied in the market. So as I mentioned, this implied volatility based on assumptions of traders creates a volatility based on the speculation of traders. So you see, the markets may or may not be volatile, but option pricing based on option buying lets us know what the option buyers are thinking the market will do. Therefore, they are implying a certain volatility will exist in the market. Think of this like a volcano. I don't know if anybody's ever used this analogy in options trading, but let's just say, implied volatility is like a volcano. We have statistical data that says this volcano has blown up every 100 years for the last, 300-400 years. Every 100 years, this volcano is going to blow. So, that could be considered our technical analysis or our statistical analysis based on past events. People might start, putting bets on this volcano when it's going to start to blow. Maybe they saw some smoke come out of the top of this volcano. Maybe a little bit of lava started to come out of the top, but it hasn't actually blown yet. So people see this and they're like, oh, there was some smoke. There's some smoke. That could be like a news event. And the statistical data showing us that this volcano is going to blow up in, a couple of years' time could be that earnings event coming up on the horizon. So people are like, I'm placing my bet this thing's going to go huge. It's going to blow up big. Some people might be like, yeah, I'm not sure, I just want to protect myself to the downside. So they're going to buy some insurance on their homes. They're going to buy some puts, something like that. So this volcano is creating a lot of implied volatility. It hasn't even done anything yet, but there's a lot of speculation of what's going to happen in the market. Same thing with the stocks and the options. So this volcano, just like the stock, may not even do anything. It might just consider, just trading along sideways, and the whole option market's going crazy. There might be some truth in that volatility based on what speculators are thinking, but most of the time, implied volatility is overstated. People usually think it's going to go up too much or, fall too much. And we'll talk about that here in a minute, but let's take a look at a bell curve here. We're going to talk about, when we're talking about implied volatility, we have to be able to kind of put this in context based on a 1 standard deviation move. So when we're looking at stocks, we're talking about stocks and options and things like that. Usually it's talked about in a, the movement of a stock, or the implied volatility is based on a 1 standard deviation move. You guys have heard that a lot. If you're selling options, you usually like to place those outside that 1 standard deviation move, which is a 68.2% is a 1 standard deviation move. But let's say, for example, we're looking at Apple, or any stock. We'll just call it any stock here. And a 1 standard deviation move, I'm going to go ahead and just draw 1 standard deviation move down here. And we'll just draw our little Greek symbols here. The sigma symbol, which is the Greek symbol for a 1 standard deviation move. Now let's say the stock here was trading at $100. We're just going to make it simple. This is a $100 stock. Now if the implied volatility in this stock was 20%, which represents a 1 standard deviation move, just so we can put this all into context, and hopefully I can put this all together for you guys here. But a 1 standard deviation move of implied volatility 20% represents a 1 standard deviation move. So in the case of a $100 stock, a 20% move to the downside would put us at $80, and a 20% move to the upside would put us at $120. Now this would be considered a 1 standard deviation move. So the volatility in this stock would represent a 20% move, which would represent a 1 standard deviation move. Now, let's say, for example, if that same, if another stock, we're going to pick a different stock, had we'll draw our same 1 standard deviation here. Now, let's say that this stock was a $200 stock. So completely different stock, but let's say in this example, the implied volatility on this stock was 50%. So what it's saying is that in a 1 standard deviation move, this stock being more volatile, a 50% implied volatility for a 1 standard deviation move is going to put this stock trading up here at 300 and down here at 100, because a 50% move in a $200 stock would be $100 to the downside and $100 to that upside, which would be a wider range. You can see that this range here would be 100 to 300, which would be a $200 range in this stock. But let's say on that other stock, we only had a 40-point range. Of course, smaller stock, smaller numbers, but you can see that if we had a higher implied volatility here, that stock range would move a lot more. So let me show you guys. Some looking at the market here. Let's pull over the Thinkorswim platform. We're going to look at Boeing, Facebook, and USO, and I want to show you guys some interesting things here. So let's come in here to Boeing. We're looking at Boeing right now, and we're trading options. We're going to come in here to the trade tab. I want to show you a couple of things in the trade tab. Right over here on the right hand side, you can see that we have some numbers. Now, these numbers represent a 1 standard deviation move. Now, this number right here, let's say, for example, let's just pick this one here, 25.80%. That 25.80% represents a 1 standard deviation move, a representative of what this stock could do based on all the calls and puts, averaging out this implied volatility in all the calls and all the puts in this series of options right here in the 16 November series. This would represent a 1 standard deviation move of 25% up or 25% down in a year's time. So that's averaging out all those calls and puts, the implied volatility and all those calls and puts. This would give us an average 1 standard deviation move of 25% to the upside or downside over a year period. Now you might be like, well, that's great, but I don't want to know what it's going to be doing in a year. I actually just want to know what it's going to be doing in 43 days from now. Come right over here. You can see this option series is 43 days. Well, you come right over here. You can see that this number right here will tell us what that expected move is going to be in the next 43 days. So we're talking a $27 move up or down in this series of options right here, the 21 December series of options. We're looking at a $27 move, and that's based on this implied volatility that is right here, based on the average of all these calls and all these puts, based on a 43 days out. We're looking at $27 to the upside, $27 to the downside. Now, 1 standard deviation move over the year would be a 26% move up or down. I hope that makes sense. I want to show you guys a couple other things here. So we're looking at Boeing right now. Let me show you what this looks like here. So we're seeing, looking down across the board here, we're looking at about a 25 to 28% implied volatility. Now, if we come over to Facebook, let's take a look at Facebook. Well, Facebook has about the same. We're looking at about 30 all across the board. Now let's look at USO. I want to show you guys what USO, United States Oil. So USO, about the same, about 30%. And that's all fine and great, right? We're like looking at these going, well, this is great, but what is, is this risky for USO right now? Well, let me show you guys something here. If we come down here to today's option statistics, there's some numbers right here that are very, very helpful to us. And I'm going to show you guys on a chart also what we look at when we're trading implied volatility. So there's a thing here called current IV percentile. That's this number right here, 90%. So what this number is, it's a ranking. So what this is saying is that if we're looking at USO, the current, if we're looking at a 52-week implied volatility high and an implied volatility low, that's these numbers right here, 33 or 33.9% or 18.9%. That's the highest the implied volatility was in a year period, and 18.9 is the lowest that it's been in the last year. Well, this current IV percentile is saying that right now, over the last year, that 90% of the time, the implied volatility has been lower than it is right now. So, you know, if we're looking at Facebook, USO, and Boeing, they all had about the same implied volatility, but that doesn't really give us any context until we put it in the form of a current IV percentile to see how risky that stock actually is. So right now we're looking at USO, and you could say that 90% of the time the risk has been less than it is right now. So a USO is pretty volatile. It's a pretty risky index right now to be looking at. So I just wanted to kind of show you guys that. So let me pull up a chart here, and you can see that here along the bottom we could add implied volatility. You just come up here and you add that in. You can see that implied volatility right now is 32.39. But if we come in here and we look at the IV ranking, which is totally different, we just add that in here, the IV ranking, and we can see that the little tag I have up here shows the IV percentile ranking at 90.2. So again, 90% of the time risk has been lower than it is right here. And so IV percentile, coming over here, we're looking at the 90%. So what it's really doing is it's taking the high and the low for the last year. So we're taking the highest high, which looks like it's about right back in here, and we're taking the lowest low, and then where we are right now is taking the highest high and the lowest low. We are at about 90% of that high and low. Here's the high and the low. We're about 90% of that right now, and that's what that ranking is. So look at that IV ranking. Again, that's just found right here. Come in here to your options trade tab, come in here under option statistics, and that IV ranking for that that stock or that index or ETF, whatever you're looking at, is going to be right there. And there's also you can add that little indicator on your screen to show you what that percentile is. But hopefully that was helpful to show you guys where that is and why we need to look at that IV ranking, not just the implied volatility. So back studies have shown that since the 90s, implied volatility has been overstated about 85% of the time. So you see, stocks usually don't fall as far as people think they will. Stocks don't usually gain as much as people think or hope that they will. Greed and fear usually make traders think the stock will rise or fall more than it actually does. And this is where us as options sellers have the edge. So when implied volatility is high, we want to sell that, because historically, time and time again, we've seen that people's emotions are usually overstated in the market. So guys, I just want you to understand, and I hope this video hasn't been too long, and I hope it's been some really good information here for you. I mean, we could talk, I could make an hour, 2 hour long video on implied volatility. But basically, you know, I was talking to a friend the other day, and we were talking about stocks and talking about options and talking about implied volatility of all things. And we're saying, you know, a lot of people will come into the market that don't understand this implied volatility, and they'll look at trading an option, and they'll just basically look at the pricing of that option. So again, let's say again we're coming in here to US oil. Let's say we're looking at the 16 December series. They come in here and they're like, wow, I'm going to buy a call on this USO. And right now they're looking at these calls, you know, the 70 deltas somewhere up in here, or the 1 deltas, like $3.20. Wow, that looks cheap. Man, I could buy that option for $3.20. Well, you could, but you know, actually right now you'd be actually overpaying for that option, because that option is really inflated right now because implied volatility is at the 90 percentile. It's 90% the highest of where it's been all year long. So those option prices are really inflated, and this is where we as sellers have the edge. You're like, well, if you want to buy that option at this price, I'll sell it to you, but it's going to cost you, and I'll buy it back from you in a week or two after that implied volatility gets sucked out and you lost money, because I was the seller and I understood implied volatility and I was on the right side of implied volatility. Now, if you're a buyer when implied volatility is high, the stock might even move in the direction that you wanted it to, but when that implied volatility starts to decrease, your option value is also going to decrease. So even though the stock made the move you wanted it to, when that implied volatility comes down, your option is going to lose value, and you actually could lose on that position even though the stock went your way. So it's so important to be on the right side of implied volatility. So a couple of takeaways to leave you guys here today is, before you make a trade, check where that implied volatility is currently. If you're trading options, definitely check where that implied volatility is. Check that IV rank and go back and look at that, where that IV rank is, and make sure you're on the right side of volatility. So if the IV, implied volatility, is high, you want to be a seller of options. If you're looking at buying options, make sure that that implied volatility is low. Another market measure you can just check too is the beta. Beta is a measure of volatility, and beta is a statistical measure of the volatility of a stock versus the overall market. I can see I got a typo right there, of a stock. The market is described as having a beta of 1. So generally, if you're looking at the market in general, that would be a beta of 1. Now, if you're looking at like Amazon, that has a beta of like 1.6. So it's about 1.5 or a little bit over 1.5 times the volatility of the general market. So just some things to look at when you're looking at those types of trades. Guys, I really enjoyed making this video. I know it might have been a little bit longer. Hopefully it hasn't been too much for you and you really got some good information out of this video. I enjoyed making it. I'm probably going to make a few more videos on this implied volatility because I feel it's so important when we're trading options. Please post your comments below if you have any suggestions for other videos that you might like to see. And just in general, love to hear from you. What do you think of the video? And if there's any questions that we could discuss, I'd love to answer you guys. Any of your questions you guys have, post them in the comment section below. If it's been helpful, please give us a like, subscribe if you felt this video has been beneficial to you. We'd love to have you on board. Again, my name's Kirk with Tactical Options Trading. You guys, appreciate you watching our videos. Thanks so much. We'll catch you next time. Bye-bye.